So, Andrew being the founder of Family Office Networks, he's put together a series of companies, family offices, and associations around the world. His background is in the fundraising business, shall we say, in the financial field. He was responsible for overseeing more than 7,000 hedge funds, a community of over 40,000 members. Professional appointments include with Morgan Stanley as well as Prudential. At Morgan Stanley, he was vice president and managed more than $100 million of high net worth individual assets. And helped manage the assets for institutions as well as individual high net worth individuals. I am going to introduce Andrew and let him go into more detail of how Family Office Networks works, type of situations that might be appealing to members of our group, and look forward to that information. Andrew Schneider.
Hi. Good morning, everyone. Thank you, Tom, for the kind introduction. I'd like to just start out and get a feel for how many of you are familiar with what a family office is. Okay, this is helpful. You know, family offices have been around for hundreds, maybe thousands of years, and it goes back to the Rockefellers, to the Morgans and J.P. Morgans, and it's been about preservation of wealth for these larger families. And in the recent years, we've seen a tremendous amount of new millionaires and billionaires between social media and the internet. We've seen just a tremendous amount of literally newly printed billionaires almost on a monthly basis. And family offices are basically an infrastructure, if you will, inside these families that manage everything, in some cases, from the outside investments that the family makes to other areas such as the philanthropy, to different tax and estate succession planning. And really, that's one of the biggest issues that family offices tackle, is the transfer of wealth from generation to generation and the problems and issues that occur with that. And we're seeing more and more wealthy families adopt this, we'll say, family office type of structure so that the transfer of wealth is an easier and smoother process. We've seen examples, for example, Stroh's beer, which was the largest beer company in Germany. The grandparents started it and turned it into, I think, a $5 to $7 billion company. They eventually handed it over to the children, and then by the time it got to the grandchildren, the company is now bankrupt. And how many other times do we see examples like this, where either a patriarch or major will start a family business and then gets handed down from generation to generation, the conflicts, the problems that arise from that. We also see a lack of planning for different families. Examples, some actors like James Gandolfini, obviously from The Sopranos. When he passed away, he really did not have we'll say, an estate planned out, and his family is going to lose a tremendous amount for a lack of planning and infrastructure there. So I would like to kind of just take a step back and just introduce myself and share with you about Family Office Networks and what we do. And how many of you here are looking to raise money, or in some form or capacity, whether it's for a company, for a charity, for any anything. Most groups are looking to raise money, and family offices by far are the most sought after type of investment group to go after, except the most difficult and toughest to get a hold of. The high net worths, the groups that I've spent my career raising money from, a lot of it has dried up just over the years, especially after '08. A lot of them have gone back to their traditional wealth managers, their Merrill Lynch, their Morgan Stanley, and which then leaves institutional investors. And for those of you that are trying to raise money, certainly know what the institutional world is like. It's, you know, they're looking for very larger investment opportunities and ones with a much larger infrastructure. So it's been, in the last 4 or 5 years, some of the most difficult times for raising new money that we've ever seen, especially for alternative investment products. When I say alternative investment products, that's hedge funds, private equity, real estate, and other esoteric types of strategies. And we've seen just a very challenging time for raising new money. And family offices are the one group that's actually allocating and that's actually investing new money into real estate, private equity, hedge funds, etc. So with that being said, just my background, I'm from New York. I'm sure a few others here are from New York as well. And I moved down here about 15 years ago. I came out of Morgan Stanley. I founded a company almost 20 years ago called HedgeCo, or hedgeco.net. Basically, I created at the time the largest hedge fund website database in the world, back when no one knew what hedge funds were. And on one side, I allowed hedge funds to list their products on the site for free, and they would update every month their performance. On the other side, it was free for accredited and qualified investors to come onto the site. They would fill out a long questionnaire asking everything from net worth, liquid net worth, what type of experience do they have, do they invest in real estate, private equity, etc. I would personally give each one of these a call, introduce myself, find out what their, we'll say, investment objectives and goals are. Some of these were very receptive and were open to looking at everything. Others had more strict parameters and would specify what they're looking for. And then I would get permission to go back and introduce different products and services to them. At the time, I acquired a broker-dealer and raised money for about 450 different hedge fund products. Again, I was really at the right place, the right time, the right place. 2001, I'm sure we all remember, with the dot-com crashing, the markets down 30, 40%, hedge funds became in vogue. And when hedge funds became in vogue, there was very few places to find information on hedge funds. So I had, fortunately, the largest site. At the peak, we had 7,000 hedge funds that were reporting on a monthly basis. And then on the other side, we had about 25,000 accredited or qualified investors. And just to give you an idea of the demographics, about 70% of them were high net worth and family offices. And that is really the sticky money. It's what we call the relationship money. And most importantly, it's what we call the referral money. Because I can't tell you how many times we'll get referred to other friends, other buddies, golfing buddies, other country club members, and then we had about 30% institutions. We had all the foundations, endowments, pension funds, etc. We were about 65% domestic, 35% global. It's a big world out there, and we did very well with our global distribution. I sold my last company about 6 years ago, and I started my own family office, and which led me to just see the inefficiency and let's just say just disconnection between the family offices out there and the whole family office industry, which is estimated to be anywhere between $5 to $10 trillion. And family offices, are typically reclusive, in some cases exclusive. And but what I did see, and for dealing with family offices for as long as I have, a lot of families wanted to meet and to be able to share ideas, co-invest, and so I decided to launch Family Office Networks. Family Office Networks is now the largest community in the world. We have over 45,000 members. The goal of Family Office Networks was to bring family offices together so that they can share ideas. They can share access to different products and different, we'll say, investment professionals. And the site is very content driven, and we again were very fortunate in the last 5-6 years. The family office industry has just taken off, and now I'm seeing family offices in the news on a daily basis versus 5-6 years ago, maybe once a month, every 2 months, you would see family offices in an article. At the same time, what I did was I launched the Palm Beach Family Office Association. I've been down here for 15 years now, and what I wanted to do was events for family offices in Palm Beach so that they can meet each other, they could co-invest, they can, again, talk about local issues, and the first event I probably did about 3 or 4 years ago, and I did it at someone's house who's a member of our network, and she's got a beautiful, beautiful house. We had about 100 people come, about 60, 65 family offices. And what was very interesting was I saw how the families were connecting, and they were connecting for different reasons. Their kids going, for example, to the same private schools. They were members of some of the same churches, synagogues, country clubs. They were talking about some of the local issues, we'll say, in Palm Beach. And we started doing a series of these events and built a tremendous, we'll say, Rolodex of just relationships in the Palm Beach area. At the same time, we're also capturing the family offices that were relocating from the Northeast predominantly. So from New York, Connecticut, Boston. And a lot of them, as they were moving down, would come join our network because they wanted to meet other family offices in the area. And because the success was really tremendous, we launched the New York City Family Office Association. Same goal, which was to do events, and everything we do is very high-end. And so we launched the New York City Family Office Association to meet and capture the family offices in the New York City area. That took off. We launched the Connecticut Family Office Association. Then we did Boston, Miami, Naples, Chicago, Silicon Valley, San Diego, and about 10 others. And each one of these, we have someone with, we'll say, boots on the ground, where we're doing these very high-end events, bringing family offices together with other investment opportunities and, we'll say, different service providers. And by doing these regional events, as I like to call them, doing them in their backyards, that's how we're able to get access to the families that are, let's say, between 100 million to 500 million, the toughest ones to get access to. And the reason they come to our events is because we're doing it in their backyard. By doing local events and these regional events, we've been able to build this incredible network and distribution into the family office space. Last year, we did probably about 75 events. And that was throughout the country. We're also launching in the next 3 to 6 months, we're launching the London family office. We're launching Geneva. We're launching Hong Kong, Singapore, Brazil, Toronto. And basically, if you want to meet family offices in Seattle or in San Francisco, you need to be there and have a presence there. And that's what differentiates us from other groups that do these bigger events. Our events are more intimate, where we'll have 80 to 100 people on the high end, and then we do a lot of lunches and breakfasts, more of an intimate type of setting. The families that we deal with prefer to come to these because it's people that they know, people that they recognize, and we continue to build this network out. And by the next year, 2 years, we hope to be in another 30 to 50 more locations. And each one of these locations, we're doing, let's say, 4 to 6 events a year. Very, again, high-end type of events, and bringing family offices together with other investment opportunities, different philanthropy, luxury goods and services, and that's how we've been building our, we'll say, network and distribution. The way we monetize this model is going back to what we do best, which is raising money. I'm in contract right now, and I'm purchasing a broker-dealer. For those of you not familiar with the whole broker-dealer issues, in order to get compensated and to share in a success fee, it needs to go through a broker-dealer. So, does anyone have any questions?
What's your website address?
FamilyOfficeNetworks.com, and then each one of the associations we have a separate website for. So, for example, New York City is nycfoa.org. So that's New York City Family Office Association. Palm Beach is pbfoa.org.
Are those links on the major?
Yes, they should be. Yes. Okay, I'm sorry.
I presume then that each of your offices are autonomous. For example, in California, Silicon Valley, you'll have a permanent representative out there holding events.
Yeah, I'm sorry.
Okay, I mean, you mentioned you have all the various branches. So let's just use California.
Sure.
Let's presume in Silicon Valley you have a permanent rep or person out there who handles the events.
Correct.
Okay.
Correct. Yeah, I'm sorry, was there another one?
Oh, I was just gonna, so I'm more involved in philanthropy, as I mentioned to you, and then you talked about this. Have you ever met Susan Bradley, Sudden Money? Okay, so the whole concept of what happens with the young people inheriting these things but not being prepared because these family offices don't have. With a group that I'm involved with, they did a webinar, and it was based on philanthropy, but it was talking about the generational differences. So the matures, which are the older people, and they're more trusting, and so they're going to do things, and they trust the government, versus the baby boomers come along, and they're like, we don't trust anybody, yay. and so we make very different decisions. And then the millennials coming up, which particularly with this wealth transfer, don't really have the basis. So what's what I'm getting at? So address that from your perspective and how you advise your clients.
We acknowledge the fact that technology is going to be a very important role. And how many of you here have millennials as children? Okay, so I'm sure you can all relate, and we've added a technology platform, and we're going to continue to invest in technology, knowing that millennials and the transfer of wealth as it goes to millennials and even further down, is less relationship driven, and it's going to be more technology as well as relationship, but technology, you can't ignore it. So we'll be pretty active. And just touching upon what you said, the reason we have different verticals such as philanthropy, we have a separate website just for fonphilanthropy.com. We also have, for the last 2 years, we work with luxury companies. For example, Hatteras Yachts is a client of ours. They make yachts. We have the Four Seasons, their clients. We've got plenty of other luxury companies that are now starting to come to us because of our distribution, and it's just a natural fit. So we get a lot of interest from private aviation, certainly from art and different collectibles. There's a lot of opportunities. And a lot of times we can't get in the front door with an investment opportunity to a family office. So we'll get their interest in art and do an event around something like that, which will attract other families that may not have come to one of our events that was more investment focused. And so that's a big reason that we do and have these other verticals. So. Yes.
I have a technology investment question.
Sure.
Because you have so many, as you say, millennials who find that very attractive. And I'm just curious, because so many of the larger companies have never really made any money. If you look at the OTC filings, it's between two great big parentheses. But yet, they'll be very engaged with it. The price is $70, $80 a share. How do you address the schism between never making any money and being incredibly engaging in which to invest?
Oh, that's a tough one.
Sorry.
It's a kind of a case by case. We evaluate and look at pros and cons and opportunity cost and.
So you wouldn't necessarily stay with a blue chip as relevant to how you say maybe you want to put a little casino money in this orange. Let's just use it as an example.
Yeah, I mean, look, we're pretty open and agnostic, and our interest is helping the family offices, and that's really, those are our clients, and so however we can better service them. And if you talk to most family offices, their interests range from getting access to good deal flow and access to good products, and that's certainly one of the bigger interests. Philanthropy is certainly definitely high on the totem pole. What we're seeing just on the investment side, and when people ask sometimes what we do, sometimes I respond by saying, we're like a dating service. Like a high-end dating service. Let me clarify that. What we do is we match, we'll say, investors with investment opportunities. The investors being family offices with different investment opportunities. Most of the family offices that we're working with, a lot of them are looking to raise money for deals that they're involved with, but they're not looking to mass market it. What they're looking for is to get a few other families to co-invest with them. So for example, let's say there's a piece of real estate that's $500 million, and the family would normally take the entire purchase down. Instead, they'll put up maybe 50 million or 100 million, and we'll help them find a few other co-investors. And what makes it very sellable is that it's, they've got their own skin in the game. It's a family office offering their product to other family offices, and that's been our niche. Our specialty is working with family offices that have their own products and that are looking for other families to co-invest with. And in the last maybe 2 years or so, we've raised a lot of money for a lot of different, we'll say, entities. The majority has been raised with products that are offering some type of yield. With interest rates at historic lows, there is a big demand for any type, either current income or any type of current yield. And what we're seeing is groups creating products ranging from hard money loan to asset-based lending to different real estate strategies such as, purchasing multifamily homes or student housing and collecting, income and then either paying the investors. The demand for income and yield for family offices is definitely one of the biggest areas. Impact investing in the last 2 years we've seen grow tremendously. Is everyone here familiar with impact investing?
Actually, I think so, but probably not.
Sure. It's when an investment is made and it has a social positive impact, yes, on, So we're seeing a demand on both sides, on family offices that are looking for impact types of investment opportunities, and we're seeing a lot of different impact groups trying to target family offices because it's a very good fit. We've seen a lot of money going into different private deals, and whether it's a fund that's structured, that's investing in different deals or going in deals directly. And what family offices are doing, and there was a big article in the Wall Street Journal, is they're disrupting the investment banking industry. And they're making it cheaper and more efficient than normally if a company was looking to raise money, they would go out and hire an investment bank. The fees that an investment bank charges, eventually it gets passed on to the investor. With family offices, you're seeing them get involved and basically lowering the cost tremendously. And they're out there, whether doing the deal themselves or syndicating it out to other families that we help introduce them to. Yes, sir.
I'm curious, recently are you seeing a resurgence of interest in early and later stage pharma biotech?
Absolutely. Sorry, I forgot to mention that before. Life sciences, biotech, healthcare, just demographics in general, it's a very favorable trend. I've been actively raising money in that space for over 20 years. In the last 10 to 12 years, we've seen and have been responsible in placing money into really all across the board, from early stage to we'll say later, more mature companies. Yes.
Andrew, there's a Chicago-based group I think called Family Office Exchange. Any interface with them at all?
I think they're a very good group. The difference is Family Office Exchange. What they do is they charge family offices about $30,000 a year to come to 1 or 2 events a year and offer very educational services. 5 years ago, that was very helpful. Now, so many groups are all offering the same information. So I don't know how effective it is. We work with them and we'll distribute any white papers they have, but our model is the opposite. We never charge family offices. We want them coming to our events, and so it's just a different model. There's been a huge growth of multifamily offices. And how many of you in the room have heard of multifamily offices? Okay. It's a multifamily office, in my opinion, is probably the biggest misused term that I've seen. On one end of the spectrum, a multifamily office is supposed to be managing money, let's say, for other single-family offices, where it's a investment advisory firm, and it's managing money for the smaller single-family offices. And on the other end of the spectrum, you have multifamily offices that don't manage any money but provide all these other services, such as tax preparation, succession planning. They'll do a concierge service. They'll walk your dog. They'll wash your car, everything. And then we have what I call hybrids. If you're familiar with GenSpring, for example, they're a $13 billion multifamily office, the largest in Florida. They're headquartered in Jupiter. I've known them for almost 20 years. GenSpring is what I call a hybrid. They do both. They manage money as well as they offer these other, ancillary types of services. But we've seen a big growth in multifamily offices, and it's again all trying to capture these single-family offices. Yes.
Andrew, thanks for all the information. Appreciate your time speaking to us. What are some of the people that you deal with telling you about sustainable? So every day, whether it's battery technology or electric cars, are they trying to shape that, or are they, what are they asking you about that?
That's more of a specific question. We've done events, with topics that are somewhat similar, and the turnout has been very good for the events that we do. And you're welcome to come and attend, our future events, and we can make personal introductions so you can hear. But it's somewhat of a case by case, depending on the family. Yes, sir.
Andrew, obviously taxes are a big issue for the people that you're dealing with.
Yes.
Do you have any particularly favorite concepts that you like to use to help you with the tax code?
I think as we spoke about this before, let me ask, how many people here are familiar with tax credits, cost seg and R&D tax credits? Okay.
Historic property tax credit.
It's historic. Okay, it's tax credits, and it's something we've been familiar with for years. But I've been amazed with how many people are not familiar with it. When we get approached by, if not hundreds, thousands of companies every week come to us because they're looking to raise money. And when I talk to the CEOs or CFOs of the companies, if they're private companies, they're a technology software company, a biotech, and most of them are not familiar with the R&D tax credits. And it's amazing when they hear about it. The typical response we get is too good to be true. And once when they get past that hurdle, you know, it's a no-brainer. On the cost seg with the commercial properties, and we find people are more familiar with that, but still, there's a big disconnect between just the education, knowledge, and the services out there. And I think what you're doing is great. And sorry, go.
Sorry, another question, Andrew. Any interface with entrepreneurial schools like Babson College and so forth and their alumni groups? They've got some pretty distinguished, successful, you know, enterprises, Home Depot, etc.
Not really. You know, I guess our niche is we work with smaller to mid-sized groups. We don't, the groups that we don't work with are the billion-dollar groups. They don't need us, and we don't need them. Our niche is working with smaller, emerging companies, you know, middle market companies, and groups that you know, that really want our distribution, and that's what we're most effective. And just to add on, the way we work with companies that we are actively raising money for is, let's say a company retains us and they're looking to raise $100 million. What we do is we'll have them go to New York, where we'll have 2 or 3 days of meetings set up just for that group, with maybe 20, 30 family offices that have expressed interest in that product or that strategy. We would then have them go to Connecticut for a day or two and have meetings set up, to Boston for a day or two, to Palm Beach for a day or two, Miami, Naples. Each one of our locations serves as a distribution point. So sometimes we don't know what's going to sell and what's going to work. Our job is getting, you know, the issuer or the family in front of other families, and from there we kind of take a step back and let the process take place. And you know, it's been working for many years.
I'm just curious, do you disclose to the family offices that you're getting the fee from presenting them?
Yeah, absolutely.
And what is the nature of the disclosure? Like, do you tell them how much, or is it how transparent?
It's not. It would go through the broker dealer, and then they would sign off the investor knowing exactly how much. Not only does it have to be specified, but the exact amount has to be specified and disclosed to the investor. And these families know that, you know, we do make money, and this is how we do it. And you know, our goal is to find a, you know, good product and good deals for them. And that's why we have this big network of other family offices. And you know, between their own deals and between our relationships, we're always still looking for good deals, good products. Okay, sorry. Yeah, and yes.
Hypothetically, let's just say a company came to you and they were seeking to raise, let's just say 10 million to make it simple.
Mm-hmm.
They engaged you, and then you sent them. They went to New York, they went to Connecticut, and between the two, they did raise their money.
Mm-hmm.
At the end of the day, would you mind telling us what the cost would be for that company to raise that 10 million?
Sure. It depends on the company. I mean, you know, if it's a startup company, if it's a venture capital deal, we're going to charge more. If it's a $500 million hedge fund with a 5-year audited track record, that's a lot easier. So, you know, we would charge less. I mean, it's kind of all over, but we make a few points on.
And they would also be paying a fee to each. Let's just say half came from Connecticut, half from New York. So they'd be paying. There'd also be a fee for each of those parties.
Well, we don't charge the investor. We're charging the issuer. I mean, the company that's trying to raise money. We charge you. We're not an investment advisor, not yet at least. But that's our next goal, that we will be launching our own asset management firm, because we have some family offices that would rather us just manage the money and put it into the deals that we like the best. So that's part two.
Andrew?
Yes.
I mean, let me clarify a little bit, because Andrew and I have had a discussion before, and it's something that would be important to a number of us that are here. There are 7 scientists here in the room, or people that are directly related to the sciences and raising money for sciences. One of the problems is the cost of the fee to an early stage company can be a problem. So we're talking about putting together a small fund, small being probably about a $50 million offering, that would be composed of maybe 10 different early stage bioscience or medically related companies. That could be of interest to a number of us that are here, all right? That would reduce the fee to each one, and at the same time still have the power of the family office network, and allow the social side, the philanthropic side, because we're talking about curing cancer or diabetes or whatever it may be. So you've got that aspect of it.
Well, I'll take it a step further, Tom. I'll take it a step further. The key there is diversification. So when we're going to a family office and saying, look, you can invest in a fund that's invested in 8 or 10 different biotech, life science, or healthcare companies, so we're spreading out your risk, we'll be able to get larger dollar amounts. But that is a very good point. Yes, sir.
How favorable are the family offices to startups, and how do you screen and qualify startups?
Great question. Startups obviously are the toughest. We look at obviously pedigree, background, but a lot of my decision is predicated on infrastructure. So if I see a company that's using, let's say, a top law firm and the top accounting firms, it gives us more confidence as we go out and versus groups that are using firms I've never heard of. And it's hard enough to raise money for startup ventures. So, and there's not much that we're able to look at. You've got pro forma numbers, but pro forma numbers are they're pro forma numbers. enough. To this day, I'm yet to see any pro forma numbers that were negative. In 20 years of doing this, I would figure someone would be honest and say, yes, I lost money in 2008, or I would have lost money if we were invested in. But it's amazing. Anytime someone shows me pro forma numbers, obviously they all look great. I'm still waiting, and I believe there's someone out there. So,
what industries are people allocating to?
We discussed that before. Biotech, any type of yield plays, which is asset-based lending, hard money loans, factoring, student housing, and just direct deals. We've seen money go into the cannabis space. That's been growing very actively. Yep. But for the most part, real estate and private equity. That's crypto. It's a very, very new field. I met with a few groups. I was in New York last week, and we had some deep talks about that. And it's still a little bit too early for the families I'm talking to, but it's something we're definitely keeping an eye on. Yes, I'm sorry.
To build on the gentleman's comment about sustainability, and you just mentioned student housing. So in the development area, that development meaning building areas and sustainability issues, is there interest? And also, I'm hearing that there's a lot of, and there's a name for it, but it's assisted living.
Yes.
Yeah. What's that?
Assisted living facility.
Facility, okay, ALFs, right?
Yeah.
Okay,
Yeah.
so, not my field. So these are like growing, but the idea of making them sustainable, the idea of building communities that are actually more friendly to people, and more mobility, and also, again, looking at baby boomers, which are gonna be, we want retirement communities that aren't based on the old concepts, but then work with the new ones, and we want sustainability and energy efficiency and all that stuff. So can you address that?
I mean, the assisted living, we're seeing obviously a huge growth in that, and for the same reasons, just a better quality. Student housing is a good example. And when I was in college, the housing was much different. How many of you have kids that are in college? Okay, and you've seen the housing and very nice. I mean, it is expensive, but it is very. I was really blown away. Like, these kids are, they've got a pretty good deal. But I think you're going to see the same with assisted living as well.
How do you find the families? I know just marketing.
The way we find the families, a lot of it is going back for me almost 20 years of doing this, but by doing them in these other cities and other locations, that's how we're able to get the local families. For example, we did an event in Orlando maybe 2 months ago, and I would never have thought of doing an event in Orlando. And we had a good turnout, about 80 to 100 people, but there must have been 2 or 3 billionaires that were actually at the event. And just the quality was unbelievable versus other areas that I've been to. Other cities that we've done well with are these smaller, like Nashville or Naples. Again, we're able to get access to each other because they'll invite other families because we're doing them, again, in their backyards and making it easy for them. We've also been fortunate that we have such a strong web presence. We've got over 25 different websites. We also have Family Office Recruitment, which is another business we have. We have Family Office Magazine you're going to see. It's going to be coming out every quarter. It's a mix between family offices and luxury. It's a very, we'll say, high-end magazine. There's an online and an actual magazine. And so families hear about us through philanthropy, through luxury goods and other ways that we target them. Yeah, we also do have a weekly newsletter that we send out, and that's very helpful.